please welcome Adam Curtis from Perpetual for our first presentation. Thank you.
It's pretty hard to follow, Peter, but wow, fantastic. It's pretty remarkable to see a room packed to the brim, full of excited faces, eagerly awaiting, I think, the first of many sessions on the topic of fixed income. So congratulations to Switzer for pulling such a group. Congratulations, ladies and gentlemen, for giving up a bit of your time. Dare I say it, for lack of a worse pun, thank you for your fixed interest. I'm going to talk a little bit about bonds. I want to talk a little bit about how we think about managing it at Perpetual, and I think picking up a little bit on the theme that Peter spoke about, the relevancy that fixed income can provide in uncertain times. The beauty of fixed income lies in its predictability and in its certainty, and today the market is full of risks, but the pricing for risk is not fantastic. So I want to talk a little bit about that through the lens of hopefully something that resonates with you. By way of big background, I suppose some of you will know Perpetual, some of you may not, so I just want to quickly introduce Perpetual as a business. We've been around since the 1880s. The board consisted of some blue-blooded people like the Fairfax brothers, Edmund Barton, our first Prime Minister. We run around $28 billion, predominantly in Australian equities and Australian credit. We run some global equities and multi-asset portfolios, and over the last few years we've taken our capabilities to the listed market. We have two products in the market there on PCI and PIC as the ticker codes. The thing that I think most resonates with Perpetual is the story of how our investment heritage began. And it began in 1966, nigh on 53 years ago, in a climate that wasn't entirely dissimilar from today. Cash rates were low, bond yields were low, and Perpetual managed a pool of assets called the Widows and Orphans Benevolent Fund. And the income that was being generated to fund the needs of those investors was insufficient. So Perpetual took a decision to broaden the investment mandate to include Australian industrial shares. That became the Perpetual Industrial Share Fund. It became Australia's largest managed fund and second oldest. I tell that story because really it talks about the evolution of how we think about investing at Perpetual. We call it quality, we call it value. What does that really mean? Find good assets, be it equity assets or debt assets, quality businesses, and buy them or lend to them at attractive prices. Quality provides certainty, and an eye on the price provides better risk-adjusted returns. Lots of things will impact the future return that you make on any investment, but I suggest the largest contributor is the price that you pay for that particular investment. We live in interesting times. I see two key risks that many of us face, many of us in this room. The issue of what we call longevity, an ageing population. We're living longer, which is fantastic, but longer lives mean more money to fund those retirements. And we're in a world where governments around the world have outsourced the recovery of economies to central banks. We know that story well. Central banks have pumped money into markets, cut interest rates to theoretical levels, and it's pushed the value of many assets up. And it introduces the risk of sequencing, the risk of drawdowns, the risks of losses that some of us cannot bear to take. Risk is asymmetric. Lose 50%, you need 100% to get back in the black. Lose 20 cents in the dollar, you need only 25%. So for some investors, the best way to make money is not lose it. But a lack of risk, and Peter talked about that, in portfolios with cash rates where they are and TDs where they are and bond yields where they are, introduces a bigger risk of running out of money. So how do we find that balance? How do we build the certainty that we want in portfolios? And it's different for different investors. It's hard not to generalise. The beauty of youth is that we have time in the market. The greatest risk we face when we're young is not taking enough. We should maximise our returns, but as we move through our accumulation cycle and we approach or we're in retirement, we've got different risks. The risk of drawdown, the risk of longevity, all those other risks. And managing volatility can be different for investors in that part of their journey than necessarily those at the start. And I suppose that's the relevancy of fixed income. It doesn't have the cachet of some of the other markets that we talk about almost hourly, if not daily, the equity market. It's a shame. Because it's the biggest, it's 2 to 3 times the size of equity markets. It's the oldest. Governments and companies were issuing bonds well before they listed exchanges in Holland in the 1600s. And I'd beg to say it's the most important because it forms the pricing of everything. the pricing of every asset, the houses we live in, the shares that we trade in. And with all this complexity and all this sort of diversity at Perpetual, we've tried to design a team of what I would call specialist lenders, 8 investors that are focused on one thing, finding the best of fixed income and credit investors. And I don't have the opportunity to go through bios with time, but there are 2 personality traits that I think fit our investment team. They're patient, they know opportunities come and go, and they're risk aware. Not risk averse, but risk aware. Our job of stewarding your capital at Perpetual is to ensure we're adequately compensated for the risk we take. We manage about $8 billion in this asset class. 2 fundamental objectives. We want to provide you income, but we want to provide you income in the context of what I would call fixed income stability. And there's a range of ways you can generate income in your portfolios. You know it better than I. Dividends from equities, rental properties, TDs, hybrids. But I think the beauty of a good portfolio is complementarity, and I'd encourage you to think about that as you listen to the presentations today. In the world of income, what does fixed income really mean? Your money back when you want it. An income stream that's predictable and hopefully through the cycle, above cash. But really importantly, from a portfolio construction perspective, something that's got a low level of relationship or correlation with the other assets that you already own. I'd suggest that a well-managed fixed income portfolio should give you the capacity to take risks in other investments with greater confidence. Because well-managed fixed income is about getting your money back and getting certainty. It's a hell of a tough subject to explain succinctly, and you're going to have a long day listening to it. But every asset, every security, every fund that someone talks to you about can sit somewhere on these axes of what I would call duration and credit risk. Duration is interest rate sensitivity, and credit risk is that you lend to someone that doesn't pay you back. Understand those 2 risks before you buy something. By way of interest, our income product on the exchange, PCI, has no interest rate risk. We call it short duration. All the fund managers, I'm sure, will talk to you about investment philosophies and investment principles. There are really 2 that I really want to sort of mention today. And it's the asymmetric nature of fixed income. Beware of concentration risk. Make a good loan, get your money back. Make a bad loan, and you can lose it all. With equities, you can lose it all, but the upside is uncapped. You really only need 2 shares. As long as one goes up by more than the other one falls, you're in the money. But make a bad loan, you can wait 50 years to get your money back on the other one. I love concentration risk in equity portfolios. I would caution against concentration risk in fixed income portfolios. And the second principle is don't push it too hard, because it won't look like what you want it to look like when you want it to look like it. Geez, that was a mouthful for a Monday morning. You can lend longer. You can lend to a lower quality of borrower. You can lend down the capital of structure, and you'll get more coupons. You'll get higher yields, but you'll also get the same sort of risk you already own. If you push it too hard, it'll look like the things that you actually already own and that you're seeking to diversify from. I've only got a few minutes left, so I can't really go through everything, but what a world we live in today. Who's got an income objective of -1%? But there's about 20 billion bonds out there that are issued at that level or trading at that level. There's even negative yielding, high yielding bonds. I don't think anyone would feel sorry for a Swiss banker. Anyone at the back of the room can see that. That's the 50-year curve, nominal rates that are still negative. Very patient investors. And we know what's happening in the world. Companies are issuing debt. They're buying back their own shares. Treasurers are issuing bonds. Why? Interest rates are low. So duration's got longer and longer. Interest rates have got lower and lower. Don't buy an investment because it exists. Buy an investment because it suits your objective. And we know this story well. We're underinvested in fixed income, maybe because we've got one of the best performing stock markets in the world. Fantastic. But markets change. Portfolios evolve. And I'd encourage you to consider your allocations and the heavy reliance that we have on a couple of risks in the core of our portfolios. I know some of the other speakers will talk about this at depth, so I'll go through it very briefly, but it's a big world. There's been about $100 billion worth of issuance in the Australian credit market, $10 billion in high yield year to date. Issuers from all sorts of different companies, across all sorts of different industries, across all different parts of the world, issuing here. That's great opportunities for you to access, but also risks to manage. And the challenge in fixed income is it's hard to access because primarily it's over the counter, it's not exchange traded. We can all buy shares on our phones, through the ASX, but with fixed income, by and large, the parcels are still institutionally traded, $500,000 and up. And it's in that light that I very briefly introduced the Perpetual Credit Income Trust to you. It's a trust that listed in May of this year, raised around $450 million. It's designed to give you a diversified pool of loans, of high quality debt securities to pay you that predictable income stream that I've talked about. 3.25% after fees, paid monthly and performing pretty strongly since it's listed. It's a flexible investment mandate. It's a wide investment universe. It's deliberately built so because opportunities are never the same all of the time. And we want to be able to access them regardless of their credit structure, regardless of their geography, regardless of their industry. So it's a broad investment mandate designed to make opportunities and returns predictable and certain. These are the types of loans that you might find in the portfolio. Some of the names will be familiar to you, some of them less familiar. The core of our portfolio is by high quality investment grade loans, and then ultimately where we have conviction and we've done the research to allocate to high yielding opportunities with conviction. In a world that lacks opportunity, given the price risks, there are still some attractive risks in fixed income. We've made loans to Asiano at I think 5.5% in the last couple of months. Qantas near at 4.8%. Senior loans in private companies at 5% above cash, secured by the assets themselves. These are companies you may well own equity in. But sitting at the top of the capital structure, our coupons are paid before your dividends. And that's the beauty of fixed income. The reality is, and Peter touched on it before, if we could buy term deposits at 8%, my mum and dad wouldn't need these sorts of investments. But they can't. And I'd encourage you to think about some of the opportunities that you'll hear today and talk to some of the firms and talk to some of the managers that can think about these risks because frankly, there are lots of other better things to do with our time. A relationship on the fund there, I suppose the core points I'd make to you, highly diversified, 90 different issuers, 75% in the capital structure, yielding about 2.5% above cash today, below our targeted return. Why? Because we're a bit conservative, we're keeping it short, we're keeping it high quality. If there are 3 things that I'd like you to remember from today's presentation, beware of interest rate risk. It's the momentum trade in markets today, but don't lock in too low for too long. Don't push it, fixed income too hard because it'll end up performing like equity. And think about the price that you pay. It's rare in life you'll find something that's cheap and popular at the same time. 9 times out of 10 you'll do better buying cheap. Thank you for your time, Peter.